I mean, I think the Romanian situation, it does concern us quite a lot. What's happening in terms of the political situation there, that definitely has had an influence in terms of confidence, both internally and externally, over the last 2 to 3 years. The fundamentals of that market is 22 million people. It's the next largest country outside of Poland. So from a logistics perspective, that should bring a market of 2 to 3 million square meters in volumes. That hasn't happened. But from our point of view, we're not going in there to create a portfolio of 1 million square meters. We're going in for key customers to deliver key products. So it's a slightly different focus than maybe what was happening in 2006-07, where people were creating larger portfolios and buying larger portfolios. From a development perspective, that's how we look at it. So, but it is concerning, and it will take a longer time to sort itself out. On the other side, that's maybe a more internal question. On the other side, you still have some key investments going into that market in terms of being automotive, suppliers, retail in Bucharest. I mean, if you go into a number of the shopping centres in Bucharest, I've never seen people shopping like crazy. And they are shopping because they have bags. So there is a manufacturing side on one side and there's a retail side on the other. Just now it's not coming together, which could be the reason, the governmental reason, which means it's going to take 2 to 3 years before it really shakes itself out.
No, I think the main thing is, people like Craig, he's producing the right investment product. It's down to fundamentals. It's a good quality asset with a good lease and a good tenant. You get the fundamentals right, there is investor demand, even if it is in Romania and some of the more far-flung markets. Because the current investors, they are the more core investors looking for core product, prime product. Obviously, Romania, Hungary, there's an opportunistic angle to those markets. It is a brave, a bolder step to go into those markets. And they'll only go into those markets generally if there is a quality asset which these guys are producing. And we see the same in Poland and Czech. Most of the investors are focused on core prime product because that's where the debt is, reasonable quality debt, and the equity is targeting those markets as well. So it's a market for prime core product at the moment, and the German funds are probably the most active across those markets.
Sorry, Walter.
Yeah, I mean, if I hear what Daniel's saying and I put it together with what Josef has been saying, that 90% of the investment is in Poland and Czech Republic, it sort of underlines the point I wanted to make that today I don't think Europe is divided between Western Europe and Central Eastern Europe. Today Europe is divided between Northern Europe or stable Europe and Southern Europe where nobody wants to invest. So in a way, people are dividing the world, as Daniel has just done, by the countries that everybody wants to invest in: Germany, France, UK, Poland, Czech Republic. You might add Scandinavia to the list for some people, maybe the Benelux for some people. But then you've got Southern Europe with Spain, Portugal, Italy, and Romania and Hungary, which is basically the area that is considered difficult. Not to mention Greece. I mean, this is the way that the investment world looks at Europe today, and I think that shows that Poland and the Czech Republic clearly have sort of matured, and I would to an extent challenge whether a place like Poland is really considered emerging market anymore, or not.
Can I ask, would you finance in Romania and Hungary at the moment?
I mean, in Romania, definitely not. In Hungary, well, we did a deal in Hungary for Heitman in December last year when they bought 2 office buildings in Budapest. So I think, generally our bank sometimes does look at individual opportunities outside core markets, and we also did 1 or 2 deals in Spain earlier this year. You would clearly do this only at a very low leverage and high returns, but in principle we would be willing to look. But as I said, I mean, the general issue I have is that Hungary, if you look at the macroeconomic fundamentals, doesn't actually look that bad. Nor does Romania, in terms of what they've done with their indebtedness, how they've tried to stabilize the economy. They've done steps in the right direction. Unfortunately, they've combined it with very populist politics, and in the case of Romania, probably even silly politics. that is certainly not helpful for investor sentiment. And it's difficult to understand why that needs to be done, because potentially, if you look at where Hungary was in 2003, 2004, they were always very close to Poland and the Czech Republic, and it was that sort of triangle of Warsaw, Prague, Budapest that started it all. In the case of Romania, I think it's also an issue of, in my view, substantial mispricing. Romania, after Poland, Hungary, and the Czech Republic had entered Europe, and Romania was on the road to Europe, I remember that within 12 months we saw a yield compression of more than 300 basis points for Bucharest. That happened inside 12 months. And that brought Romanian Bucharest prime office yields down to 6.5% at the peak. And I would clearly say this is overpriced. And to an extent, one of the issues that Romania, in my view, suffers from today is that there is still no pricing basis that makes sense. Because if you look at Poland, we've said 6.25%, 6.5% for prime office. Arguably, that should mean that in Bucharest you'd be at least at 9.5%. And I don't think that there is anything to be sold in terms of prime office at 9.5%.